Hello, this is Delilah Azelia Lobato Faria, student of the University of Wollongong in Dubai, presenting my midterm paper for the subject Fin323. The first question discusses whether asset allocation has changed with respect to the UN SDGs. The first part of the answer discusses what are the 17 Sustainable Development Goals, or SDGs for short, and how they contribute to the welfare of the people, a greener planet, and economic prosperity. The answer then discusses how one can contribute to the SDGs alongside financial goals by four steps recommended by the Global Impact Investing Network, which includes screening for sustainable investment opportunities, setting measurable goals for achieving SDGs, selecting and structuring investments based on achieving both financial and SDG goals, and finally, managing and reporting quantifiable progress in terms of SDGs and financial growth. The main disadvantage lies in the lack of opportunities evidenced by the table on the slide. The next part of the answer justifies that additional effort to target SDGs through investment would help ensure that investments are more focused, safer, future-oriented, adapted to competition and regulatory changes, and thereby leads to higher prospective returns, lower volatility, and more durable investments. The material reference for the answer discussed is shown on the screen. The next question involves using four stocks to determine if it is better to invest in sustainable or unsustainable companies. The companies selected are all based in the USA, and the judgment of their sustainability is based on the achievement and effort toward the 17 UN SDGs as on their sustainability report. The two sustainable companies selected were Cisco and Autodesk, whereas the two unsustainable companies selected were Kraft Heinz and ExxonMobil. The table compares the average return, standard deviation, and coefficient of variance derived on Excel based on the data extracted from investing.com. The results indicate the following. On average, unsustainable companies have lower average returns. Standard deviation of unsustainable companies is high, indicating financial volatility and therefore no assurance of returns. Coefficient of variance, which is a good indicator of the level of risk, is very high for sustainable companies such as Kraft Heinz and negative for both the sustainable companies. The material reference for the answer discussed is shown on the screen. The third question discusses 5 sustainable investment strategies that I would recommend to a client. The answer begins by stating that sustainable investments is a mean that allows one not only to achieve their financial goals but also to impact SDGs simultaneously, allowing them to contribute to a better planet, better opportunities, and thereby a better future for themselves. The first strategy is by investing in green real estate investment trusts, also known as green REITs, which is similar to mutual funds but comprise entirely of real estate. They have returns similar to Standard & Poor's 500 index and is a means to diversify portfolio. They also offer significantly higher returns compared to traditional REITs. The second involves rebalancing of one's portfolio by investing in green companies or green bonds, basically investing in opportunities that help fulfill one's social responsibility along with financial responsibility. Benefits include safety, as they are unlikely to face disruption, and also diversification, which eliminates some unsystematic risk. The third strategy would include investing in ETFs, or exchange traded funds. Investing in ETFs are comprised of companies with low carbon emission or green efforts, and ETFs that support social improvement projects are one way to do so. Another convenient strategy would be to use investment technology that automatically restructures investment towards sustainable projects, such as the robo-advisor Earthfolio and the reinvestment program Sustainfolio. The final recommended strategy would be to divest from unsustainable assets that currently exist within one's portfolio. This would work best with the second strategy of rebalancing the portfolio, as the green investment which they are planning to invest with which matches the nature of the unsustainable investment can be switched in for the same amount as the unsustainable investment exists within the portfolio. The material reference for the answer discussed is shown on the screen. The final question discusses whether capital market theory can be extended to digital currency. The answer begins by discussing the capital market theory, stating that it comprises of 8 assumptions. Therefore, to see how it applies to digital currencies, 3 of the 8 assumptions are applied to digital currencies to see how well the nature of digital currencies matches the assumption. The first assumption that is tested is whether there are no taxes or transaction costs involved in buying or selling assets, which is found to be not applicable to digital currencies. There are 3 main hidden costs in all digital currency transactions. Firstly, the fees paid to the exchange to use their services to safely and easily obtain and convert digital currencies. Second, fees paid to conduct and verify transaction, the pace of which is directly proportional to the amount paid, which is sometimes fixed. The third fees is the wallet fees for the safekeeping of the digital currencies. The next assumption tests to see if there is inflation present due to digital currencies. This is untrue as digital currencies cannot be controlled by people or organizations or governments. They only obey the laws of math and the limits imposed by the algorithm and depend entirely on the limitation of computational power. Therefore, only limited amount can be mined or produced as the limit approaches, it gets more difficult to produce more, thus curbing the monetary inflation. The third and final assumption tested is whether digital currency can be infinitely divisible. This assumption holds true as digital currencies are preferred for micropayments. Though currently the smallest value that the Bitcoin network handles is a Satoshi, equivalent to 100 millionth of a Bitcoin, but if needed in the future, the network is capable of dividing a Bitcoin into 100 billion parts or more. The material reference for the answer discussed is shown on the screen.